Thank you for joining us today. Given the market environment, we thought it was a very opportune time to hold another leverage finance Mizuho market mindset discussion. I have with us Jim Boland, who's my partner and runs capital markets, and Stefan Kullberg, who helps run our CLO business. So thank you for joining me, gentlemen. The impact of AI on the software sector has left a big void in the market. And we've all read endless articles about the impact on the term loan B market, the private credit market, and to a lesser degree, the high yield market, but it really has spilled over throughout the whole market. What I wanted to talk today is something that isn't as covered as much, and that's the impact on the CLO asset space. And so, Stefan, can you talk to us about your market a little bit and how this is impacting your investors?
Yeah, of course. I would say software started becoming a concern Q4 of last year. The CLO market from a primary perspective and the secondary perspective was largely business as usual over the first 2 months of the year. So the primary side over since February did slow down a little bit as software became less of a focus in terms of managers to be able to ramp into new issue CLOs, whereas liabilities widen out. Now, it's not perfectly correlated in terms of why did liabilities widen out, because we did have the Iran war in the background as well over the last month. But the reality is, on the new issue side, liabilities widen out. Managers have decided to ramp into a smaller software bucket today, which has made the ARB a little bit worse off. And so that slowed down primary volumes over the last month or so.
What do you think turns that around?
So I think that managers are still going to be focused, at least in the near term, on issuing new CLOs with a smaller software allocation. So whereas pre headlines in February, managers were comfortable ramping anywhere from a 10% to 15% software bucket, new issue CLOs today are ramping with about a 5 to 8% software bucket. What that means is there's probably a smaller universe of loans to buy. It does make the asset side a little bit more difficult. And since liabilities did widen out largely because of the Iran conflict, a little bit due to software, the ARB has been more challenged. That has started to clear. The Iran war risk premium has dissipated a bit. So we are seeing AAAs as well as mezz bids come tighter, and we are seeing the new issue market start to open up again.
Jim, on our side of the fence, we've been in a very bifurcated market for some time where there's have and have nots, and that's both on the industry as well as specific credits. When you think about the wave of acquisition finance that came through over the last 4 to 6 weeks, there was one very common theme. Issuers saw a very muted term loan new issue demand, but yet a very strong high yield bid. As a result, those structures flipped from bank to bond for many of those transactions. Is this the new normal?
I don't know if it's the new normal, but in the high yield market, you are definitely on firmer footing relative to the CLO term loan B market. And I think a large dynamic of there is just the CLO market has been the bigger investor in legacy LBOs in the software sector, more so than the high yield market. It's probably up to a factor of, I'd say, 3 to 1. And as a result, you see a lot more selectivity in that loan market, in the CLO market, largely because it's just they're trying to avoid mistakes. And it's starting to spread outside of software into adjacent sectors that could also be exposed to displacement from AI. The high yield market has been sort of a savior, especially on a few transactions we were involved with in the last couple of quarters around the ability to resize that transaction into the better demand in the high yield market. And again, it's TBD how long this is going to play out. It's probably really came to the forefront, I'd say late February, early March, when AI started to become a big focus as a risk to displacing some of these software names. And as a result, you've got perfectly performing credits that have traded into the 70s. So if you're a CLO owner, historically, you haven't been the rescue money in the market. And if you're looking to mitigate exposure, you've got, again, a credit that's performing by all metrics. Do you really want to monetize that hit in the 70s or the 80s, even if that bid is really there? Because my sense is if you try to show up with any type of size into that market to sell, it's going to gap down from there. So the quandary is, do you just sort of play this out and try to figure it out over time? But right now, there's definitely greater strength in the high yield market than there is in the CLO market.
And then obviously you also have the private credit market over there, which is also over indexed to software assets, and at the same time is facing redemptions. So, for the last 6 to 8 quarters, we've seen a lot of private credit deals refinance into the term loan market, mainly because the interest savings is very attractive. Do you think that's sustainable? And where does that paper get refinanced?
I think the trend of, especially on the software side, of refinancing private credit into the term loan B market is effectively dead. I think there was a decent amount of migration, I think, in 25. But there's also, at the same time, direct credit was still very much alive in a lot of these M&A processes and very competitive. And we found sort of as of late, especially with the redemptions that's going on in the private credit side, that they seem to be less, you run into them less in M&A processes as a competitor for financing, especially on the larger transactions. They still seem to be somewhat active in some of the smaller transactions, especially in the middle market. But as a whole, I think the damper on both sides, both in the CLO market and the private credit market, is effectively brought M&A in software to a lull. So you've got a lot of existing stuff that I'm sure some of these sponsors would love to sell in this market, but they're going to have to take a decent haircut around valuation, just because I don't think the leverage is there to support those transactions in this environment. It's very much a risk off the sentiment in both private credit and the CLO side. Now, the difference here is the beauty of the CLO market versus a lot of these private credit structures, which are set up as private BDCs, is they're obviously subject to these redemptions, which you see obviously on all the in the newspapers and on just all the business channels around the issues they're running into there with excess redemptions. The CLO market is, most of these vehicles, and Stefan, correct me here if I'm wrong, but most of them are set up as 12-year locked up money. You've got a lot more flexibility. You're not subject to quarterly redemptions in that market. So you can sort of play the string out a little bit on the risk side on a lot of these software names. Whereas on the private credit side, you're much more under the gun just to manage these redemptions.
That's correct, Jim. CLOs are essentially a long-term non-mark-to-market vehicle. And so there is no forced selling pressure from managers on underwater, underperforming software loans. Now, while there are some metrics within the CLO structure that do limit things such as CCC migration, defaults, et cetera, that may catalyze a manager to act sooner than later, as of right now, managers have been patient on the software exposure in their portfolios.
Do you think that they can play through this, or do you anticipate LMEs and other ways that they have to kind of fix some of these problem spots in their portfolios?
I think the takeaway right now is maybe manage your exposure on the margin. So there has been a little bit of lightening up on software exposure, particularly from managers that have been overweight the asset class. But the reduction in exposure has been pretty small, about 50 basis points only across the portfolios. Other managers have been taking a little bit of an advantage. They've been bringing an underweight a little bit up. But again, it's been a pretty small percentage of the overall portfolio size in terms of what they're moving. Most managers right now are largely focused on managing the market values of portfolio. So willing to do swaps, as in I can sell this loan at 95 and maybe buy another loan that I like a little bit better at 95 as well, to keep the market value in line with what was existing before the software loans went down.
And the jet fuel for our market is really the new CLO creation. The last couple of weeks we've seen very anemic volumes. How's the health and stability of the AAA bid, both from a cost of capital perspective as well as from a demand?
AAA bid's very strong. I would actually say that largely the move that we saw over the last month and change has been driven more due to Iran headlines and just general repricing of relative value across both securitized products as well as credit asset classes. And so CLO just moving out in kind with that. Maybe on the small margin, there's been a little bit of a reshuffling of manager tiering. But I think in terms of overall CLO spreads, that was reacting more to macro factors rather than micro factors, i.e. the software market.
And by managing tiering, do you mean top tier managers versus maybe smaller and new entrants? The gap of cost of capital is increased over time.
Definitely. I mean, it's definitely an opportunity for smaller managers to show their performance. They're lower exposed to software. Some are starting to ramp new issue CLOs or come to market today. It's definitely an opportunity for them to grab market share and grow faster than they were expecting. Whereas existing managers with higher software exposure, they're more or less managing their existing client base, explaining their portfolios, et cetera, like that. I don't think there's going to be a large move away from the large tier one managers just because they're so embedded in the market. These are large institutions. People have faith in terms of their credit abilities, and so guys will still stick with them over the long run.
And Jim, from a new issue perspective and a secondary, it's super interesting because absent a few sectors that are very challenged, other parts of the market, deals are getting printed at tighter credit spreads than we saw in Q1 or even Q4 last year. And so again, it's that bifurcation that we're seeing. Um, how do we leg out of this market? And kind of what is your guess of kind of the trajectory as we begin to cure these more problem spots in the market?
Jeb, you're absolutely right. Away from software and some tangential sectors to that, you are definitely seeing old economy names embraced in part of this market. And some of them are, from a pricing standpoint, as good as it was last year or pre this shakeout in the software sector. What sort of solves this is historically, when you look at some of these cycles where you've gotten credit as a whole has gotten disintermediated, it's usually been an opportunistic new money investor or an existing manager bringing up a new side pool of capital to take advantage of the dislocation. I think since this has really been a so far 2-month play or sell off in the software sector, you haven't seen that opportunistic capital arrive yet, but at some point it's just going to get so cheap that it's going to get really interesting. There's a lot of talk around high yield sort of stepping in to pick up some of these discounted assets or for new money deals since they're less impacted by the software exposure you're seeing in the CLO market as being, a place to go in terms of selling some of this risk into. It just feels early. It feels like a lot of these credits that are performing should not be trading where they are, but it's just a fundamental of the current marketplace. So I'd say only time would tell, but usually what sort of steps in here is there's new money that's sort of targeted at this dislocation. We just haven't seen that in size yet.
Yeah, and look, it puts it in perspective. It is a quarter plus that we've seen this. It just feels a lot longer that we've been in this market environment. And I would just add, I think the dearth of M&A and the lack of pipeline that's across the street will help cure the market as well because people will have to eventually look for ways to put money to work.
I would completely agree. You're definitely, especially after the latest larger transactions that just went through the market, there is definitely a drop off in the backlog in terms of near term M&A volumes or new money volumes coming to this market. We're starting to see a little bit of a pickup on that on the M&A side, but there's definitely going to be a supply drop off where some of this existing paper that's trading at deeper discounts, you may see a little bit of upside or a little bit more interest in picking up some of that exposure.
And one last question, what KPI are you watching that you think is important for investors and issuers to keep an eye on?
I mean, I think for individual software loans, earnings are going to be closely watched because largely we've had this price migration despite earnings staying relatively decent across the entire sector. So we've seen this big move in price. Rating agencies said, look, there's been a move in price, but there hasn't been any catalyst for us to actually think about downgrading these ratings. Obviously, if the software sector starts becoming more at risk of downgrades, there could be more price pressure there as managers do start to think about triple C migration within their portfolios. Absent that, one catalyst to the upside is definitely loan inflows. I do think that one of the bigger drivers of the price action that we saw in February was more ETF loan outflows, retail loan fund outflows as well. Because like I said, CLOs were not the seller of BSL software loans back in February. They sold on the margin in small amounts. It was largely just as loan outflows and more of a repricing of what bid do these loans clear at.
Well, look, never a dull moment. There's always curveballs thrown at us. And as Jim said appropriately, we're in the early innings of this market, and it's balanced with a very constructive market for the vast majority of issuers. So we look forward to smoother market environments and continuing discussions on the market. Thank you for your time today.